Hello everybody, welcome to part 4 of exam trade. So this particular video will be dealt on balance of payment, meaning of balance of payment and the importance of balance of payment, components of balance of payment and disequilibrium in balance of payment, and how to cater to disequilibrium through few measures. Even that will be done at the last slide. So let's start by understanding what is the balance of payment means. Balance of payment, it's a predominant, a very important and a magnified statement. It's a statement which is done taking monetary details into consideration. So the monetary transactions, to be very precisely, on a year basis or on a half yearly basis or a quarterly basis will be taken into consideration, where there are two very important things that will be entered or that will be recorded in the monetary transaction statement, that is BOP, is inflows and outflows. Inflows is the goods coming into the country or the money coming into the country or any such transactions that has led or given something in turn that will come or enter into a country will be classified under inflows. Outflows can be outflow of money, outflow of people, outflow of any such monetary things that will be recorded under outflows. So inflows and outflows on a particular date from a particular date to a particular date, as I told, probably it's done on a yearly basis, will be recorded, or simply you can say the number of exports and the number of imports that are done on a yearly basis or half yearly basis, that is recorded under a pro forma or a statement, and you call that statement as balance of payment. A balance of payment indicates a country's economic status. As I told, it includes exports and imports on both the sides. An export and import of a particular country for a particular date must tally. A proper balance of payment or a perfect balance of payment is that export is equal to import and it is zero, that is, there is no difference at all. It's a nullified thing. And the balance of payment comes with the three situations, that is, export is equal to import, export is greater than import, that you call it as surplus balance of payment, import is greater than export, that you call it as deficit balance of payment. Okay, so let us understand why this balance of payment is given very much of importance and it's very significant in a country's economy. Firstly, a balance of payment helps a country to understand its financial or economic status, because when you have something that is as a record that is already there, that has been recorded for years together, when you have it, it helps you to know whether you have enriched or grown as a country over a time, whether you've become stronger with respect to your financial aspects and economics facets as a country. And the currency appreciation and the currency depreciation of a country is also something that can be easily understood and taken care. If at all your country's currency value has over a time it's gone high, it's improved, obviously it's appreciated. On the other side, if a country's currency has fallen down in the global market, in the foreign exchange, and that's a depreciation factor. So even before anything can happen, it gives you that proactive approach where you can see what is going to happen, because you don't just prepare a balance of payment just for a year and you forget it. It's something that you have to prepare eventually, enduringly, consistently for years together. So it will give you a clear picture about how you moved or how you built as a country over a time. So it gives you a platform where you can see whether the country's currency is appreciated or depreciated, and also the fiscal and trade policies of the government that must be prepared by the government of a country is also very much influenced by this balance of payment. So it gives a lot of details for them to prepare a proper fiscal and trade policies of a particular country. So that's how important balance of payment is. So let us go to the next slide, where components of balance of payment is mentioned. As you can see in the picture, the components of balance of payment is trifurcated: current account, capital account, and financial account. Current account are inclusive of goods and services. So the current account is used to monitor the inflow and outflow of goods and services between countries. So you have your country and you have the other countries whom you are dealing with, whom you are transacting with on a daily basis. So if there is movement of goods and services take place, obviously few goods that you export will move out, obviously few goods that you purchase will be imported and will come into the country. So this inflow and outflow movement of current goods and services will be recorded specifically under current accounts. So this account covers all the receipts and payments made with respect to the raw materials and manufactured goods. So this is a major chunk, the major classified account under a component of BOP. And the second element is capital account. Capital account, as in the picture is indicated, it includes all assets. Okay, all the capital transactions between countries will be monitored through capital account. Capital transactions include like you purchase a particular asset, you sell a particular asset. Assets can be land, properties, something that is of having a lot of value in it, and something that is very difficult to be bought because the quantity of money that has to flow into it's pretty high. So if at all you go for those kind of items, will be recorded under capital account of BOP. And the third one is financial account. So the financial account includes funds from the foreign countries through which investment in real estate, business ventures, foreign direct investment, etc. Will be monitored and entered. So purely portfolios and investments of diversified investment options and everything will be included in the financial account. So these three are the components of balance of payment. Let's go to the next slide, where the causes of disequilibrium are mentioned. Disequilibrium, it's the state of not having equation, it's the state of not having equity. As I told, a perfect balance of payment is where imports are equivalent to exports, or you can either call it as exports can be more than imports. But if there is some sort of disturbances that actually not let you to either have a surplus or a nullified or a equal balance of payment, there comes this disequilibrium. There are three factors which can cause disequilibrium in balance of payment. The first one is economic factors, second one is political factors, and third one is social factors. So the first one, economic factors, considers the changes that will happen or that functions within the economy. And you can just classify the economic factors or the causes into three, that is development disequilibrium, cyclical disequilibrium, and secular disequilibrium. So any sort of disturbances or any sort of differences that will happen with respect to the economy in the country can be called, or they can be labeled as economic factors causing disequilibrium in BOP. And the second one is political factors, like a lot of political uncertainties and risks and a lot of instabilities within the political arena or the regime of a particular country, or the external disturbances that are caused by the political changes around you also can be one of the reasons why there can be disequilibrium in BOP is caused. And the third factor is social factor, that is changes in the culture, cultural exchange, cultural shock, changes in the taste and fashion. It's all about like acceptance or the inhibitions that you have, whether you'll be accepted or not. Those things will be have their own share to contribute when the BOP goes away from equilibrium state. So these are the major causes behind disequilibrium. Let's go to the next slide, where methods of correction of disequilibrium are mentioned. If at all you have disequilibrium, you have a problem there, and you must have a solution to sort it out. So there are two very important and very very significant measures that are there. The first one is automatic corrections. Automatic corrections deals with foreign exchange. It deals with the demand and supply of foreign exchange or foreign money. So it's a state where your demand for money is more, foreign exchange is more, but the supply is less. So during those moments, or during those days, this particular automatic correction deals with the particular concept like increasing exchange rate and making imports costlier and exports cheaper. So this particular line is used and enforced in automatic correction, through which your disequilibrium can be corrected and brought down to equity state. And the second measure is that deliberate measures. You have three deliberate measures under that. That is monetary measures, and trade measures, and miscellaneous measures. So monetary measures, they aim at reducing imports through reducing money supply. Like, you want to have a control or tight fistedness over the money that has been flowing into the economy. So by having a control over it, you are reducing the imports that you can go for, or you used to go before. And the trade measures are divided into export promotional measures and import control measures, just to make sure that your exports are enhanced and given importance, so that you don't have any need for importing. And the last one is miscellaneous measures that include loans in foreign currencies, attracting foreign investments, and attracting NRI deposits, and all those, just to make sure that your situations can be made a lot better. So these are the methods of correction of disequilibrium. That's all for the video. Thank you so much for watching.